This part is very simple, very easy. So basically, what are the different forms in which you can make alternate investments? In order to understand and get in the depth of real estate, private equity, hedge funds, we need to understand a few basics so that while we are discussing different categories of hedge funds, different categories of alternate investments, you're able to relate to it. So what are the different ways in which we can invest? So one is direct investing, one is indirect investing, and one is co-investing. So let me use an equity example first, which you'll find it very easy. Direct investing is when I am buying, let me take another share, Amar Raja Batteries shares or Exide Industries, let's say. So I am buying Exide Industries shares, that is direct investing. When I am buying a mutual fund shares, that is indirect investing, because I am buying the shares of mutual funds. Lot of us are investing very small amounts of money into that, and then the manager is professionally managing and then investing into these companies. Let's say the mutual fund I have invested into has invested into Exide Industries. So therefore that becomes my indirect investment in Exide. I am buying Exide, direct investment. I am buying a mutual fund that is buying Exide, indirect investment. And third is co-investing. So there is no bar that if my mutual fund, suppose my mutual fund has purchased certain stocks, I can also directly invest in those stocks. So co-investing is where you have also invested in a pool of securities and you are investing into those stocks indirectly yourself as well. See, in case of mutual funds, it doesn't matter, because in mutual funds the management fee etc. is not very high. So because thousands of crores are pooled, a huge amount of money is pooled, it's not a problem. Now what happens in portfolio management services is the minimum ticket size is 50 lakh rupees now. Earlier I think it was 10 lakh rupees or 25 I think, and then now it is increased to 50 lakh rupees. Say for example I have 5 crore rupees to invest. I will hire two PMSs, two fund managers, personal portfolio managers. They will manage 50 lakh for me. Okay. I have 4 crore left. Now those two managers, they will keep on giving me updates, insights, information about how they are investing and everything. And based on that, I will invest my remaining 4 crore. That will become co-investing, although that's unethical. I mean, it's not good because ultimately you're investing 5 crore based on those two managers. So just because you do not want to pay them that management fee and all, their incentive fee and management fee on that, you're doing that, you're investing in the same stock separately, right? But this is normally what happens. This is normally what a good number of people do that. But it's okay. Take it. That's how the industry is running and everything. So that is that. Now when I'm looking at the same thing in the form of, let's say, a real estate or in the form of a private equity. So let's understand. I will explain this whole thing taking an example of, let's say, real estate. Okay, then we'll see private equity and all of that separately. So what are the three different ways of investment? Direct investing. Direct investing could be buying a house. Indirect investment could be buying an REIT. I told you real estate ka mutual fund, real estate investment trust, where we people can invest very small amounts of money and that is pooled together to buy those IT parks and office spaces and all, which generates a huge amount of rent. We discussed that, and there is nobody who's stopping you from investing in an REIT as well as maybe buying an office space in one of those buildings and renting out one small office space. If you have that kind of money, why not? Tell me, are you following this? So now what is happening? In case of direct investment, what is the investment? So you are purchasing the asset yourself. I have to buy the house or the office building or the office in a building or a commercial space, a shop in the mall or something. So I'll have to buy that myself. No outside manager, but own managers. So one, either I buy it myself, rent it out myself and do all the work myself, or I'll have to hire a personal manager. Obviously, it will not be feasible if we people do it when we are investing small amounts of money. For larger knowledgeable investors, this might work, because for those people, it will make sense to have that kind of cost. Somebody who's got a portfolio of 100, 200, 500 crores, they could actually do all these things by themselves, hire their own personal manager who's taking care of these investments. So that is the kind of money you need. Say for example, sovereign funds, let's say family offices, let's say there is, let's say Azim Premji's family offices there. So Premji Foundation. So that has got a huge amount of wealth. Now that wealth is being managed to generate returns and conduct businesses and everything. So these guys will be able to afford their own personal managers rather than investing in mutual funds. They would not want to invest in mutual funds. Are you understanding? Because why? Because they will have more choice and control. Because with that kind of money, I would want to customize my investments. And with that huge amount of money, I would want to generate good returns over the long-term period and customize. Maybe I would want to have an office space. Say, for example, I want to invest into those venture capital companies which will help me. I'll give you an example. There was some study I was going through. TCS or Infosys or one of these companies, their good amount of their CSR spending goes into training and all. Because once these people as a part of their CSR objectives train people, it becomes a talent pool for these people to hire from. So if I'm doing a PE investment, say suppose Reliance Foundation wants to do some venture capital. They might say that no, I want to invest in more of solar and renewable energy and those VC startups. I don't want to invest in startups which are into e-commerce and all. They might want that because they want to enter into it, or they might say that I want a lot of e-commerce, I'll acquire it in JioMart. So you have more choice and control. You can do things the way you want, which might complement your business or something. There is no outside manager fee. Obviously, there is an inside manager fee, but you don't have to pay fee outside. And when you're having a manager fee inside, you can always have a lower fee because maybe somebody is managing a huge amount of money. For outside manager, you might need to pay incentive fee and everything, but here you may not have to. You might give a salary plus bonus or something. But outside, you have to pay a management fee based on the percentage of assets managed. Here, that may not be the case. You don't have to pay management fees outside in the form of management, incentive fee, etc. The disadvantages would be less diversification because you have huge concentrated investments to be made. You're buying one office space, one office building and renting it out. So when you're making a direct investment, it has to be a bulky investment. When I'm buying REIT shares, I can just invest 5,000 rupees. So this is going to be bulky investment, less diversification, high minimum investment, bulky investment, and less diversification because I cannot buy 1,000 flats probably. You're understanding, but I can invest into 20 different mutual funds also. I can invest in 3, right now we have 2 or 3 REITs, but I can invest in all the 3. But in case of flat, if I have a 10 lakh rupees horizon investment amount, I will not be able to diversify across 3 asset properties and all. Greater expertise, time and due diligence needed because when I'm investing in a fund or an REIT, I don't have to do so much of due diligence because they have an auditor, they have those processes and all, it's listed on the exchange, so everything is taken care of. But if I'm going to buy the property myself, I have to decide which geographical location is good. But when I'm investing in REIT, it's their problem to figure out which office spaces they want to buy and rent out and all that. I don't have the time, I will put my money into REIT, now you people manage it professionally. That's the whole reason I'm paying high management fee and all. So these people will have an advantage of greater expertise from the professional managers. They don't have to spend time. They will need greater expertise. They are directly investing. They will need greater expertise. They will need to give more time and they will need to do their due diligence. These things I will not have to do if I am doing indirect investing in REIT and all. Their disadvantage becomes my advantage. Next one is indirect investing. In case of indirect investing, I am investing in a pool of assets and not the assets directly. Along with other investors, small amounts of money can be accumulated here. Professional fund manager will be hired. I don't have to spend my time, expertise, due diligence and all. Fund managers will do. I will not have to buy the asset or office building or property or whatever. These people will do. They can buy wherever in Bombay, Bangalore, wherever they want to invest. And huge investments they can make. I will just give 10,000 rupees. Right? Agreed upon strategy. The strategy has to be agreed upon from before. So say for example, even when you're investing in a mutual fund, the mutual fund will beforehand mention that this mutual fund is going to be investing into mid cap, which is more risky than large cap, so think and invest. So they have a strategy. There could be a fund which is value driven. There could be a real estate investment trust that is going to say that we are driven into hotel properties or hotel REIT. So they will invest primarily into hotel properties. There could be an REIT which is into warehouses, data warehouses and all those commercial spaces. So you decide which REIT you want. Now you cannot say that I will launch an hotel REIT and I will start investing in warehouses or commercial property. You can't do that. So you have different categories. So there is an agreed stated strategy that this is the kind of mode of investment we will follow. So even if you're investing in a VC fund, you can invest in a startup directly, or you may not be able to invest in 100 startups, but you can invest in a PE fund. The PE fund will be in turn investing into multiple startups. Here you will have a control on the startup you've invested to guide them to, turn them on the basis of the way you want. But here that will not be possible. And in case of P1 fund also, a P fund might be saying that, we want only VCs in biotech, I want to invest, or clean energy sources I will invest. I don't want any other kind of venture capitals. So you'll invest in a fund that specializes into that zone. So the advantages is you having expertise, professional managers are doing this. More diversification because multiple investors are pooling in huge amount of money. You have a larger asset base that you're investing in. Less expertise, time, due diligence, because it is a professional manager's job to take care of it, which property to invest in, all of that. Low minimum investment required, because multiple people are pooling in together. I know the investment is very high when you look at it from a PE fund. If you're investing in PE fund, you need probably $1 million to invest, let's say $1 lakh or whatever minimum amount. But still that is less than as compared to if you would have invested into 20 startups yourself. Ultimately, so many investors have gotten together to invest, right? Cost of manager is high. Management fee, incentive fee, both you'll have to pay over here because you are getting professional managers. And there is no guarantee that just because you've hired managers and you're paying a management and incentive fee, therefore your returns are going to be higher. So there is no guarantee. So that is a problem. But of course, you're going to be trying to figure out and trying to get the best possible manager that you can in order to invest. So there is no guarantee. I mean, just don't think that, just because we are paying such managers and such fees and we are hiring professional managers, therefore it is guaranteed to give great returns. That is not a guarantee. But the probability or the likelihood should be more because you're hiring professional managers, right? Then we have co-investing. So co-investing is contributes to a pool and is allowed to invest directly as well. So what happens over here is you try to take advantage of the manager. So there are VCs also, even in PE funds and all, it is possible that you have invested in a private equity fund and you have also co-invested, you have invested directly in the startup as well. So maybe in one startup or in one venture capital company, you have investments in two ways. One is a direct your stake that you're holding and one is an indirect stake that you're holding through the fund or something. I'll give you one example, although I'm not too happy with that, but so Tata has stake in two airline companies. Now Air India has come, but even before they had in Vistara and Singapore Airlines. At times it creates a lot of conflicts also. But here there are two competing ones. But here you are investing in the same investment through two ways, through two modes. So one you invested through, so at times it could kind of raise a little bit of issue because the manager figured out, he got the investment done. And now you want to invest an X amount of money. The manager will not get that management and incentive fee now on the direct investment that you're making. And it was a manager who was able to figure out, do the research and everything and got you invested into that asset space. It is also possible that you might have invested in that startup earlier and then the PE fund invested into it. Then obviously the PE fund cannot blame you. But there are cases, of course, the volume of this would be lower as compared to these two, but it reduces overall fees because you're not only investing through the fund, which is having a good amount of fee, but you're directly investing as well, which has low fee, right? Has access to professional managers. So one, you're getting opinion and discussion and everything. This very well suits the PMS example I gave you, right? Portfolio management services. 50 lakh you'll put through them and the remaining 5 crore you will try to manage yourself based on what these guys are advising. You'll have more control because one, you're invested through the fund as well as directly. But again, the problem is that again, if you're investing directly, you need more expertise, time, due diligence, etc. That has to be done because you're directly involved. But this will be significantly reduced because you have a professional manager who has invested into it directly as well. Very easy theory part, nothing much. Comfortable, easy, tell me.
The first one, example, funds means
sovereign funds, etc. Not mutual funds and all. Like sovereign funds is something which want to invest directly. Because mutual fund is an example of indirect investing. So let me write sovereign in case you guys will confuse with that.
So, but if you invest in sovereign fund, that will again be indirect investment only, right?
Sovereign fund is my client now. So sovereign fund is investing. Sovereign fund is government's fund. I am not investing in sovereign fund and then sovereign investing elsewhere. Okay. Sovereign fund is government's fund. Government is investing. So government will not invest through mutual fund. They would rather directly hire their managers and invest the way they want. They want more control, access, liquidity, all of choices, etc. Not liquidity, control, choices and all. Comfortable, easy part.